Hello, today I'll do the stock analysis video on the Apple stock, and this video is requested by one of our YouTuber who watched my stock analysis video and put a comment on that that if I can do the Apple stock. So agenda for today is I will do the revenue diversifications to see how the Apple is doing on all its products and generates the revenue, and then we'll see the top line revenue like return on equity or the return on investment capitals, how overall from the last 10 years the company is performing. Then we look a quick glance to the enterprise and profit margin, cash flow, and also check the liquidity. Does the company has enough liquidity or not? And then at the last, I will use the net profit model, enterprise model, and free cash flow model to come up with our price and compare with the existing market price to see if is a good time to buy the stocks or we leave it. So that's from the not from the trading, but just my my personal opinion and from the long-term perspective, right? So this is just for fun, and if you want the disclaimer, if you want to buy and sell, just please consult your financial advisor. Okay, so let's get started to this interesting journey. And if you're new to my channel, I request to please give a thumbs up and subscribe to the channel. Okay, so if you see the first one, I like to see how the revenue is coming and is the revenue is growing in all for all the products or not. So the major categories for the Apple products is iPhone, Mac, iPad, and the launch of their wearable and home accessories, right? These are all clubbed together. So these are top threes are their like the main products which mostly the revenue is generating in 2019 from the iPhones, and then all others are picking up, even the services. If I compare this with the from the 3-year past in terms of the dollar terms or the percentage change, if just let's focus on 2018 and 19, and then you can pause the video and look into further. So I see that the iPhone sale is pretty much dropped 14%. That's a significant amount of drop. The Mac sale is increased, iPad is increased, but iPad is increased pretty good, is 16%, Mac is only 2%, and the wearable is increased on 41%. But even if other wearable increased by 41%, but there is not enough margin, seems like, to cover up the huge loss of 14%. So that's why the net earning as compared to 2019 to 2018, it's $5 billion less, right, as compared to the last 2018 years. The next, let's see how, because it's a global brand, let's see globally how the Apple is performing. So this is the 4-5 region. The Apple earnings or the sales are divided. So America, Europe, China is a big market itself, and the rest of Asia Pacific and Japan. And if you can easily see here, only the America regions, the sales are growing, but all other regions, especially the China, their sales is dropping, 16% drop, 1%, and rest of Asia Pacific is increased, but only 2%. But again, the major market is America, and the next one is Europe, and then on a third level is China, right? In terms of the dollar, if I want to rank them, and it's not doing much there. Okay, so that's explain how the droppage it is. So that's from the revenue perspective. Let's see how the top returns are coming. So these are the 3 top returns which we like to see. The return on equity, which is in orange, which is we can see the huge spike going to 61% for the December 2019. The return on assets is 16%, and the return on investment capital is also the 2 digits. So far is okay. Let's take a quick glance to the liquidity before we jump into find the pricing using the model. And I'll put if you want, you can pause or skip the video, but I suggest since we are doing as an investment, so please watch the full video so you know what's going on. So operating margin seems like this consistent, and the net profit margin, which is the bottom line, is pretty much consistent and over 20%. The cash flow side, this is the cash from operating operations. I like this slide because all the cash flow I can see in one snapshot. The company is doing a lot of investing, seems like, and the investing seems like it's stopped for the last 3 years, and then is more on from the payment of the finance, right? That's what it is. Maybe in terms of the dividends or share buyback, that's what it's reflect here for the past 3 years. The liquidity ratio, it was very good 10 years ago. It's close to all three are 1 now, and then they significantly dropped in 2014. And then from 2014 seems like a trend on tech sectors to pick up, because yesterday when I did the video on the Amazon, I also noticed from 2014 onward seems like it's also picked up, which I'm seeing the same scenario here. But again, it's not bad if you see the 2 out of 3 of the 2 ratio, which is a very on the liquidity side is above 1. And if you're not sure how to compute these ratio or other ratios, I have a video on my channel, and also I have a video on other stocks if you want to check it out. Okay, now let's come to the pricing. We'll use 3 models to come up with our intrinsic value. The first model is the net profit model. In the net profit model or all other models, the general criteria is I take 10 years of data and then try to and use that information in the model. So if I see the revenue growth, year-over-year growth is 14%, which is very good. But on the last 5 years, it only grows by the 2.17%. The net profit growth, again telling the same story, it was very good, 14.71%. This year-over-year growth, but for the last 5 years, it's not even 1%. So I have used the 10 years to ensure that maybe the company will come to its benchmark, and then drop the growth very significantly at using the interpolation and drop it to 2%. So I project this profits for the next 10 years, and then assuming that this historical 10-year growth rate is dropped from 14 to 2%, and then sell the company at the rate of 27 PE ratio, which is less than its industrial current PE. So, and I always try to use the 10% discount rate, so I know if I want to take any company in my portfolio, I'll have the same benchmark or threshold to get the number, right? So if company is not able to generate even 10%, then I just avoid the company no matter what brand it is, right? I don't care. At the end of the day, otherwise why not I go and invest in S&P 500? So when I do in the present value of these stocks, I got my number as $433.38. That's from my first model. Let's go to the next model, which is more on the enterprise, if somebody wants to go and buy as a whole company. So let's see from that perspective. So this is the enterprise value. It's from September again. It was $101 billion and now it's $273 billion. And the enterprise value is being consistent. But what I have noticed, the EBITDA, which is decline from 15.48 to 0.63%, right? So this EBITDA was 19 million, and then it's 19 billion and come to 81 billion. But seems like from now the company has problems to increase this earning, right? One of the reason is because we can already see their sales are dropping, and they don't have any innovative products. So that's the another problem. Not like as an invention like before, right? The debt there was no debt, but seems like now recently, for the past 5 years, the company have taken significant amount of debt, right? Before it was like a zero. The best time to buy Apple, actually, that time. Okay, so here again I have taken the 10-year average of the EBITDA and then drop it to this growth to 2%, and then I just use this growth to forecast my earning before EBITDA, right, for the next 10 years. And then I sell the company 3 times of its EBITDA. Basically, it's even a little bit over its 10-year average. The 10-year average was 2.84, but and then discounted by the 10% cash flow to come up with the present value, and then I got my enterprise value. Basically, all this sum up, I'll reduce the debt and add the cash to come up with my enterprise value from the EBITDA. I have these many shares, 4.36 billion share outstanding at the moment, and if I divide this the whole by this number of share, I got my price of $242.05, right, which makes sense because now, as we can see, the company is not growing that much. So here now I'm using the free cash flow model. In the free cash flow model, I have taken the 10 years of data, and to compute the free cash flow, honestly, is pretty straightforward. You take the operating cash flow and then reduce the capital expenditure, right? And then you just do the sum, and then you get the free cash flow for the 10 years. The annual statement for Apple ends at the September 2019, and I have taken the each year price and then compute the yield. So it seems like pretty much on average, the free cash flow on the last 10 years is generating, Apple is able to get over 11%, and on the last 5 year it's 9%. So that's not bad. But the last if I take the free cash flow growth rate for the last 10 years, the annual growth rate, which is the CAGR, so it's coming 13.5%, which is way good. But now, as we have seen as a trend, the last 5 years is negative. So Apple unable to keep up its pace, and the growth rate is reducing, right? So that's why we have seen the cash flow was $69 billion. Now it's only remain $58 billion. So that's the year-over-year rate is 3.33%. Okay, so again, I have taken the free cash flow for the current years and then increase it by the growth rate of the historical 10 years, and then this growth rate, as other models, I'm dropping to 2 years, right, just to be very conservative. For the terminal value, I have taken this as a 15 times. I think it will be very easy to sell Apple as 15 times of its free cash flow after 10 years. So you do the easy math. Okay, so yeah, and growing rate, and this is just doing the sum. I'll get my price from this model is $284, right? So now I have all 3 models, and let's see what is my final price. So first, from my first model, I gave the weight of 33% to this and get this price. Enterprise value model, I get around 80. Free cash flow model around get 96. I just simply sum it up and get my price of $319.59. If I see in the market, the price right now is $384.76. So this means the price in the market is increased. That I can easily say why the price is higher. I think there is 2 factors of it. First, with the recent shock in the earning, because Apple beats the recent quarters the expected earnings. So even in the time of the coronavirus, the Apple, comment back. Yeah, even at the time of the coronavirus, Apple increased in the sales. So that's one factor. Second factor is the Christmas season is coming. We are entering into season, market is opening up. There is a positivity in the market. So that's second factors. And third factor is the price. Apple is doing the 4 times 1 share. So what it happens, so for whatever so just divide this by 4. So this means the share price will be right now is around 384. It will be if you divide it by 4 by 1 share, then that price will be more accessible. So seems like that same share you can easily get by around $100. So what it means. So this means people usually just see the number, right? $100. They don't see, okay, how many shares are being issued behind the scenes. So they will dilute the share, so it will be more accessible, more people will buy, and which will further pump up the shares. So that's one factor. But we also don't have to forget, as the rational investor, that okay, this can increase the price for the short terms, but the recent Apple doesn't come up with any kind of new products or new kind of a growth which really shock the market. They have the iPhone and other sales, they have some wearable, but it's not really come up with that innovation kind of idea, right? Which Apple was known for 10 years ago, and we have seen that kind of a growth. So for that reason, I even further discount this price. Honestly, if I want to go and enter it to at least 20%, and so, but let me know what you think. What will be your enterprise? Will you keep it like this, or you will further wait for the lower price? Please put in the comments, and if you enjoy this video, smash that like button, subscribe to the channel, and please put a comment as well what other stock you want to cover in this video, and don't forget to like the video. I really appreciate on that. Okay, thank you, and see you soon in the next video. Bye for now.